Good day. Welcome to this session where we're going to discuss about company accounts and how we're also able to prepare financial statements of a company. Now, in this given case, it's very much important for us to begin by outlining some of the characteristics of what a company should be having for it to be called a company. One of the main things that you really need to understand when you're discussing about company is that it is established by law as a legal person, and therefore it has got what is called the legal personality. Established by law as a legal person. In other words, this gives it the ability to have that kind of a legal personality aspect where it can be able to sue, it can also be sued in its own name. Another one it can be having is regulated by the Companies Act. It is regulated by the Companies Act. Unlike other forms of businesses like partnerships and all those others, you'll find that a company is being regulated by the Companies Act. A case where you are comparing it vis-a-vis the partnership, you'll find out that a partnership is governed by the partnership deed or agreement. Another thing you can also be able to look at here is that when you talk about a company, is that a company should be able to do what is called pay taxes to the relevant revenue authorities. Like here we have Kenya Revenue Authority in Kenya here. And your nation may have a different revenue authority where you pay your taxes. It is by law required that a company should be able to file their tax returns, and in the course of filing their tax returns, they should be able to pay the relevant taxes to the relevant authorities which have been put in place for purposes of collection of those revenue and taxes. Another thing you can really talk about a company is that a company has got what is called perpetual succession. Perpetual succession. This basically means that the death of a director does not stop the company from operating. In other words, the death of someone who is working in that given company, be it a director, or maybe one of the shareholders, or maybe one of the managers, does not stop the company from continuing in terms of operations. The company will still go on into perpetuity until such a time when it will be deemed fit to be wound up under certain requirements as per the law. So the company does not die a natural death just like a person or a natural person, but it really has to go through a certain process whereby they have to follow that for them to bring the company to an end. Another thing about a company that you really need to understand is that its capital structure consists of shares. Its capital structure consists of shares. This means that unlike other forms of business where you just have normal capital being contributed, you'll find that in a company we have shares which are being given out in form of capital. So in that given case, here you'll find different types of shares. You'll find the ordinary shares, you'll find shares like preference shares. You will even find where we have equity. In other words, equity is just the capital. So a case where we have the equity, or maybe in form of the ordinary shares or the preference shares, you find all those types of shares that are there when you're discussing about share capital in a company. But rather what you should be able to understand here is that its capital structure consists of shares. At the same time, a company has got what is called reserves. A company has reserves. Reserves in this case are the ones which are helping in terms of yes. Okay, so in this case you're trying to talk about a company has reserves. This is a place where you find it is just like where all unutilized profits are carried forward to, e.g. revenue reserves. This is just an example of reserves that we have, e.g. revenue reserves. Here you find that a company does not utilize all of its profit, just like we have in a partnership, where all profits are distributed uniformly according to the profit sharing ratio and nothing is left. In a company, there was what is called retained profit, which is carried forward to the next period for purposes of growth and expansion and what have you. But in this case, you really have to understand that where those profits are taken to what we call reserves. We have different types of reserves in a company. We have general reserves. We have the revenue reserves, which is also known as the retained earnings reserves. We also have other reserves which are called like maybe the revaluation reserves, whereby after revaluation has been done, we have that. And here under equity, I also forgot something to say, something here like share premium, equity or share premium. Share premium, under that shares, we have share premium, that given case. Another thing about a company that you really need to understand is that it is governed by a board of directors. This basically means that there are people who have contributed this sum of money or this investment in form of shares to the company, and therefore they are called shareholders. They are not involved in the day-to-day running of the company, but they have, through an agency policy, given that mandate to people here who are called directors in that company, who are involved in the day-to-day running of the operations of the company, to whom they are accountable to at the end of a financial period. They'll be accountable to the shareholders as to what kind of a return have they been able to generate as a result of the investment that the shareholders had in the company. So they are run by a board of directors there. And then this is what brings special expenses in a company like directors' salaries or directors' remuneration. Directors' salaries or directors' remuneration. Using that. So they are paid a remuneration or a salary at the end of the financial period, or maybe at the end of every month. So in that given case, we also have another one that brings us to another thing, that publication of financial statements. It is a requirement by law. This is especially done by public limited companies. Remember, a company can take the form of a public limited company, or it can also take the form of a private limited company. It can take the form of a public limited company or a private limited company. But it is a requirement by law and also the Companies Act that public limited companies publish their financial statements to the public, unlike the private limited companies, which it is not a requirement for them to show their financial statements to the public. And this normally comes in case where they want to do what is called issue of shares to raise more capital from the public. So this becomes a requirement, publication of financial statements. In other words, after publishing their financial statements, they can put it to the public so that they can be able to see how they have been running their operations and how the performance has been in that particular financial year. Another thing that you also need to understand about this company is that it is a requirement by law that their financial statements need to be audited by an independent auditor. So auditing is a requirement here, where we say that auditing of the company's financial statements. Auditing of the company's financial statement. This brings us to another point where we have a special expense that is being introduced here called audit fees. Audit fees, because this independent auditor, by the process of expressing their opinion on the financial statements of the company there, as to whether they form a true and fair view of the state of affairs of the company, by the end of that process, they don't do it for free. They charge something that is called a fee. That is what is called audit fee. So when you be preparing the statement of comprehensive income, you'll find that under expenses, apart from the administrative expenses, the distribution expenses, and maybe the finance expenses, you'll find that there is also another expense that is called the director's remuneration. You'll find the audit fees is featuring in there, and what have you. So in this given case, these are some of the characteristics that you have of a company, which are very much in order if you try to look at them before I grab the board, so that you can take a question on June 2023, question 4A of a CHRP, so that you can look at how we are able to come across certain aspects of preparation of financial statements of a company that will help you follow up on how certain items are treated as when it comes to that. So the only difference between a company and other business setups is the element of tax which has been introduced, and also the director's remuneration, the audit fees, but the rest still remain the same. So these are the only special things that are there which you're going to come across. And also the capital structure of the company does not consist of just cash, but consists of what is called shares, where you'll be having the ordinary shareholders there, and also be having the preference shareholders there, and also be having something called the share premium. Share premium is a case where you find if a share, one share, is going for Kenya shillings 15, then it happened that the company issued some of the shares to the public at a value which is called 20. It means there's a difference there of 5 shillings on top of one share. That difference of 5 shillings goes to an account that is called the share premium account. Share premium account. In other words, it's an extra on the par value of the share. So if one share is trading at 15 shillings, but they ended up issuing these shares to the public at 20 shillings, so the difference between the issuing amount and the par value of the share, which is 5 shillings, is what is called the share premium. So that premium goes to the share premium account, which is also part of the capital structure of the company there. So with that short explanation, it becomes very evident that with this in mind at a glance, you are able to decipher and really know exactly what brings the difference between a company and other forms of business setups in that given case. So as I go on, it is important that we also now start to look at the CHRP question on the Statement of Comprehensive Income requirement. For those people who don't have that question, it is very much in order for you to check it on the link in the description below. Just click the link, description below. You'll find a direction where you're going to get the question paper that I'm just holding in my hand right now of Prime Water Company Limited. Prime Water Company Limited. This is a June 2023 question. This is a June 2023 question. It's financial accounting and management. It's for the CHRP, section 1, June 2023, question 4A. June 2023, question 4A. There you are given a trial balance where they're saying the following is a trial balance for Prime Company Limited as of 31st March 2021. That is the end of that given financial year. Then there's a trial balance there with 3 columns, the details, the debit, the credit, and then the total there in that given trial balance. Remember, it is from the trial balance that now we prepare the financial statements. When you are discussing about the introduction to accounting, there is something we touched on that is called the accounting cycle, where we have different phases through that accounting process. From the point where now we are initially recording our transactions, from the recording point to where now we transfer them to the ledger accounts. From the ledger accounts, we balance off and close off those accounts, and we come to a point where now we are doing what is called preparation of the trial balance, where we extract it from the balances of the ledger accounts, like in this case. Then from here now we prepare the financial statements. After the preparation of financial statements, now the cycle goes on to a point now where we have to do what is called analysis. After analyzing, now we report. That reporting is the communication part of it. That is why a general definition of accounting is that it is the language of business in which now people interact. The accountants together with the users of the financial information who want this financial information for different purposes. So in this given case, I really want us to understand that trial balance given in that given question, you can go through it and check. There is the ordinary shares. There is the leasehold property, motor vans, provision for depreciation of motor van, administrative expenses, distribution expenses, stock, purchases, sales, director salaries, rent receivable, investment income, 7% deductions, debenture investment, bank interest, debtors and creditors, interim dividend paid, profit and loss from the previous financial year. Of course, if the profit and loss values on the debit side, then we know that in that previous financial year, the company ended up in a loss. But if you're having that figure on the credit side, it basically implies that that is a profit. Then we have additional information actually, where we have estimated corporation tax liability for the year ended 31st March 2021 is 12.7 million. Then additional information number 2, it was proposed to pay a final dividend of 10% for the year. Stock for the year ended 31st March 2021 was 16.7 million. And then prepare a statement of comprehensive income for the year ended 31st March 2021 of 10 marks. So my dear friends, when you look at a trial balance, the first thing you need to really learn about is how do you identify and pick out those items that are required as per the examiner and those ones that are not required as at this particular moment. So in this given case, in a company, the most common statements that we normally prepare are 1, the income statement, which is sometimes also known as the statement of comprehensive income in other setups, like in this case. We also normally prepare a balance sheet, which is also known as a statement of financial position. Statement of financial position. And then we also normally prepare cash flow statements. We also normally prepare statement of changes in equity in a company setup. But that is for different higher levels, where now you're going to prepare those other statements. Then from there, those are the statements that you're supposed to prepare. But in this context, the basic statements that you may be required from time to time to prepare in an examination setup, especially for the CHRP section 1 and also for the ATD, for also those people who are doing the ATD 2, maybe 3, the CPA foundation level in financial accounting, you are required to understand the cash flow statement. You are required to understand the statement of financial position. You are required to also understand what is known as the income statement or the statement of comprehensive income. So, ordinary shares, we are going to use it in the balance sheet. Leasehold property, balance sheet. Motor vans balance sheet. Provision for depreciation of motor van. That one also depends as to whether there is also another provision in the additional information or not. If there is another provision in additional information, then we have to do a comparison and see whether it is an increase or it's a decrease. If it is an increase, then we have to know that that difference of the increase is going to be treated as an expense in the income statement. But if the difference is a decrease, then that decrease is going to be treated as an additional income under other income when we have already determined our gross profit. But in this case, we only have the provision for depreciation in the trial balance. So it means we are going to use it in the balance sheet as our accumulated depreciation because it is for the previous financial year. And therefore, we are going to deduct it from the cost of the asset which it relates to so that we may get our net book value. But in this case, we are not preparing the balance sheet. We are preparing the statement of comprehensive income. Administration expenses are going to be used here. Distribution expenses used here. Stock used here. Remember, when you're determining the cost of sales, the formula is opening stock, add purchases, less closing stock. We come up with that figure of cost of sales. So opening stock is going to be used, and even the closing stock, which is in the additional information number 3. We also have purchases going to be used here. Sales must be used here. Director salaries must be used here. Rent receivable must be used here. Investment, that is going to be used in the balance sheet because of the debit side. Investment income is going to be used here. 7% deductions of 15 million, that is an current liability going to be used in the balance sheet. Debenture investment, balance sheet item. Bank interest going to be used here. Debtors and creditors, that is a current liability, and also there's a current asset. Debtors are current assets, creditors are current liabilities. That is a balance sheet item, so we don't need it here. Interim dividend paid, we're going to use it here because that is already paid. Profit and loss, there, that is going to also be used in the balance sheet whenever we are going to. That is our balance brought forward of the profit from the previous financial year, which we are going to add with the profit that or loss that we're going to get in this financial year that we are working on. So that is a balance sheet item. Estimated corporation tax in the additional information, that is just an estimate. It has not yet been paid. So we are going to use it twice. We're going to use it here when you are going to deduct it from the profit before tax, so that we may get our profit after tax. And then at the same time, we are going to carry it forward as a current liability because it has not yet been paid in the balance sheet. It was proposed to pay a final dividend of 10% of the year. So after we shall have determined our profit, our operating profit, that is the profit before interest and tax, and then we subtract our interest, we remain with our profit now before tax, the PBT, the net profit before tax. Then it is at this particular moment that we are now going to apply the taxation, the tax that has been proposed or the estimated. After that, we get our PAT, that is the profit after tax. Now it is from the profit after tax that we are now going to subtract our dividends, whether proposed or interim or paid, whichever. Dividend is a dividend. So in this given case, this proposed final dividend of 10% will be 10% of the profit after tax. Because in this case, they say 10% for the year. So after getting your profit after tax, 10% of that is what you deduct as the proposed final dividend. And then we also have the interim dividend paid in the trial balance of 1,260 or 1.260 million. That is also going to be deducted. Stock for the year ended at 1st March is 16.7 million. That is closing stock. Closing stock is going to be used twice. Number 1 is going to be used in the cost of sales when you'll be determining the cost of sales. Opening stock, add purchases, less closing stock. The second time again is going to be used in the balance sheet under current assets. When you'll be listing all your current assets, this closing stock of 16.7 billion must feature there. It must actually feature there. So try to look at that question briefly. And then we see how we can be able to do it.